The next contract that we have is a swap contract. So in a swap, what happens is that we exchange cash flows. So the exchange of cash flows can be in same currency or can be other currencies. So for example, we can have a swap where we are exchanging a fixed rate loan for a fixed rate payment for a variable rate payment. We can have an exchange of foreign currency where we are exchanging one currency for another currency. And then we can have an equity swap where we are exchanging the rate of return earned on an equity contract or an equity security against a fixed income security or a fixed rate. So again, swaps are OTC contract. They are customizable. They are not trading on any exchanges. Um, there is default risk, of course, in it because it's an OTC contract, so no clearing agency involved, and they are customizable because this is an OTC contract between two parties who can actually arrange to, um, you know, uh, make it according to or make it fit according to their use. Uh, However, if you ask me, the the swaps are the most interesting and most you can say useful of all the different derivative contracts that we are going to discuss. And later on, when we explore them, you will see the possibility with swaps. Uh, Basically, swaps are advanced, complex forward contracts. So swaps are a series of forward contracts, and we will see later on how we do that, how we make ourselves understand that. So here is an example of a swap contract. Um, Company A is borrowing 50 million for 2 years with quarterly interest payment made at 90-day LIBOR. The firm is worried that LIBOR is a floating rate may increase. So this company has borrowed 50 million for 2 years and it is paying interest quarterly every 90 days. And because LIBOR is a floating rate, it may increase. And if it increase, it will increase the borrowing cost for company A. I am assuming that all of you know LIBOR. Am I right?
Right, that is London Interbank Offering Rate.
Yeah, that is London Interbank Offered Rate. Okay, LIBOR. This is the rate that is used by banks to borrow and lend to each other. Okay, that is why it is called London Interbank Offered Rate. This is the last year this rate will be used in 2021. After 2021, LIBOR will not be used, it will be abolished. And you know why? How many of you can say yes? Why is LIBOR getting abolished this year?
Is that because of Brexit or economic crisis?
No. You see, I'm asking you these questions because I know I can go through the slides. That's not an issue for me. But if you are not able to sort of contextualize your learning, if you're not getting familiar with what is happening in the markets and the economy, all this learning, no matter how good we are in derivatives or how high your grades are in on finance and investment, it will not be that much useful. Particularly when you go for job interviews. Uh, I would recommend that you learn from the internet what I would just write here. LIBOR scandal. Just write this in Google and go to um, uh, the first page. I mean, I think it will be Wikipedia. Okay, just go and read LIBOR scandal. See why Royal Bank of Scotland and these other Lloyd's Bank uh, and Citi and others, why they have been penalized by the Securities and Exchange Commission in the US. All of these banks paid 5 billion, 6 billion, 8 billion in penalties to the Securities and Exchange Commission in US. Why? Because they deliberately manipulated the LIBOR rate from 2004 to 2007, ultimately leading to the credit crisis of 2007 to 2009, Uh, and you and I know how difficult times were those for the financial markets and economies, and particularly for those people who had mortgages. Go and read this. If you don't know about this, I tell you, uh, you're not good. Okay, no matter whatever your grades are, you're not good if you don't understand how these concepts that we have in finance and investments have been utilized and have been misused in a lot of situations to benefit financial institutions and a few people. All this learning is quite futile. Okay, so go and read this, and probably tomorrow when we are in the drop-in session, we will discuss more about it. Okay, if you follow the readings, I'm just asking you to read and read and read and read. If you start doing this, I tell you, after 3 weeks, 4 weeks, most of the learning on this module is quite easy. Don't worry about the formulas, about the numbers. My job is to make those formulas and those numbers easy for you. Uh, I know that they may be quite challenging, but I will try to make them quite easy for you. And they are easy. Frankly speaking, they are really, really easy. However, you need to know the context, because I will be giving you examples from real world. If you don't know about those real events, it will be very difficult for you to understand. Like I'm asking you to read the GameStop articles that I have uploaded last night. If you don't read them, later on when I will be talking about gamma and delta hedging, you will not be able to sort of understand it easily. Of course, you will be able to understand it, but that will take you a lot of effort. So please read about LIBOR scandal, and you will learn why we are abolishing LIBOR. It is going to be no more used after this year. So now company A is running the risk that LIBOR may rise, which will increase its borrowing cost. Company A enters into a 2-year fixed for floating swap with swap dealer B based on a 30-60 day count conversion and a notional principal of 50 million. So what is happening? It is trying to swap its floating rate payments with fixed rate float payments. In the agreement, what will happen? That company A will make quarterly payments based on a fixed rate of 4.5% and exchange for a payment from a dealer B based on a 90-day LIBOR. Okay, so if I just write it here, like you see, have a look here. Let's suppose this is company A. Currently, it is paying LIBOR. So I'll just write LIBOR. It is entering into a swap where it will be receiving LIBOR, okay, and it will be paying fixed 4.5%. If you calculate the net rate it is paying, initially it was paying LIBOR, so it was exposed to the interest rate going up. Now, because it is entering into a swap, so if interest rate goes up, it will receive LIBOR in the swap. So the higher interest will be paid by the higher interest received. So it will cross and its payment will be fixed here. So let's suppose the first quarter, quarter one, what happens? Interest rates are 6% here. Okay, so it will receive 6% from here. It needs to pay 6%. It will receive 6%. So this will cross with this and it will be paying net 4.5%. 4.5%. Okay, so in quarter two, what is happening? Interest rates go down to 4%. So minus 4% it needs to pay, plus 4% will be received in the swap, and it is paying fixed 4.5% in the swap. So this crosses with this and it is. So no matter whether interest rate go up or go down, this company is paying 4.5%, 4.5%. So using a swap, this company has converted its floating rate liability into a fixed rate liability. That is the power of swap contracts. If you combine it with another asset or instrument, you can sort of change the risk of your cash flows. So here the floating rate payments have been converted into fixed rate payment. Similarly, you can convert your floating rate receipts into fixed rate receipts, or vice versa. Any question on this? Okay, next we have options. So an option is again a derivative contract in which one party, the buyer, has the right to buy or the right to sell a particular underlying uh, at a particular time in a particular quantity to the seller, okay, in the contract. So let me just write it here. So I'm just saying A has the right to buy 100 shares of Apple from B 3 months from now at $125 per share. So the right to buy, okay. So if it is the right to buy, we call it a call option. If it is to sell, then we call it a put option. And you know, all the other things are just identical to what we talked about, a forward contract or a future contract. The only thing is that here we have a right to. So the right can be to buy something. If it is the right to buy, we call it a call option. If it is the right to sell, we call it a put option. So the right to buy is a call option. The right to sell is a put option. Now, what does the right means? If it is valuable, if it is beneficial to the buyer of the call or the buyer of the put, only then they will exercise their right. So in option, one party has the right and the other party has the obligation. In all the other derivatives, in forwards, futures, and swaps, both parties have the obligation. In options, one party has the right and the other has the obligation. The buyer has the right, the seller of the option has the obligation. So this is why we call this contingent claim derivatives, and this is forward commitments. Here both parties have obligation. Here one party has the right and the other party has the obligation. Now I'll just try to sort of clarify this further given its importance. So we have call options and we have put options. For a call and for a put, we will have a buyer and we will have a seller. And here we will have the buyer of the put and here we will have the seller of the put. The buyer of the call will have the right buy the underlying. Okay. The seller will have the obligation to sell the underlying. In the put, the buyer will have the right to sell the underlying, and the seller will have the obligation to buy underlying. Now, the seller is also called the writer of the call or the writer of the put. Now, buying a call is a long position. Selling a call is a short position in the call. Buying a put is a long position in the put. And selling a put is a short position in the put. So you are long the call, you are short the call here. You are long the put and you are short the put here. Now, if you are long the call, you are long the underlying. And it is bullish strategy. Buying a call because you expect the price of the stock to go up, and that means that you expect the price of the call to go up. So you are having a long position in the call, and you are having a bearish strategy, uh, a bullish strategy, which means your expectations are that the stock price or the price of the underlying will go up. If you have a short call, then you are short the underlying and you are bearish. You expect that the stock price or the underlying price will go down, and when that goes down, the price of the call will go up or go down. So you see, when the price of the underlying will go down, the price of the call will go down, and as a seller, that is what you want as a short seller. On the other hand, if you are long the put, you are short the underlying. You expect the underlying price to go down. That means you are bearish. You expect the stock price to go down, and when that goes down, the price of the put will go up. So you expect the prices of the underlying to go down, which is a bearish sentiment. On the other hand, if you are short the put, you are long the underlying, and you expect the prices to go up, and that is a bullish strategy. So that means that buying a call and selling a put are identical. They are both bullish strategies. Similarly, selling a call and buying a put are bearish strategies and hence identical. You will have to keep this relationship in mind throughout this module, and you will get used to it as we move forward. Any question on this so far? Max?
No, it's all good.
Okay, that's good. So let's go back to the slide here, and we have this now covered. Now the payoff from an option is like, as I told you, if the price is in your favor, you will exercise. If the price is not in your favor, you will not exercise. So for the call option, like let's suppose if I want to read this, so I would say that the payoff of the call is equal to the maximum of 0 or the stock price at expiration minus the exercise price. Okay, let me just read this again. The payoff from the call is equal, the payoff from the call at expiration is equal to the maximum of 0 or the stock price at expiration minus the exercise price at expiration. Let me give you an example of this. Let's suppose I have the right to buy 100 shares. Let's make it one share. One share of Apple at $125 3 months from now. Okay, so and let's suppose today at T0 we have the stock price equal to 100 and let's make it 10, and then we have the exercise price is 125. Okay, let's suppose 3 months later, what is happening? The stock price is 140. Okay, the exercise price will not change. It is fixed because we have fixed the price when we purchase this call option. So 3 months later, let's suppose this is situation number 1. Let me give it S1. So 3 months later, it is 140. So I will just calculate how much gain I have. So my gain from the option will be CT is equal to maximum of 0 or ST, the stock price at expiration, minus the exercise price. So it will be maximum of 0 or 140 minus 125. So the maximum of 0 or 15 is how much? 15, isn't it? So I have the right to buy the Apple's share for 125 3 months later. 3 months later, the Apple's share price has gone up to 140. So I will exercise my right because I can purchase it for 125 while in the market it is selling for 140. So if I purchase it at 125, 3 months later, I can sell it for 140 and make a gain of 15. So it is in the money and I will exercise my right. If 3 months later, let's suppose the price is 120, will I exercise my right? No. Why? Because if I exercise my right, what will happen? It will be maximum of 0 or 120 minus 125. So it will be maximum of 0 or minus 5. So would I want to make a loss of minus 5? Buy something for 120 or 125 that I can purchase in the market for 120? No. Why should I purchase at 125 while I can purchase it in the market for 120? Because in the option I have the right to buy, I will let my option expire out of the money. I will not exercise. Why? Because exercising will not make any gain. It will in fact make a loss of minus 5. So I will not exercise my right, and if I want to buy Apple's share, I will go and buy it in the market for 120. Okay, so the maximum is 0. So an option cannot have a negative value. Why? Because the option gives the buyer the right to buy or the right to sell. So if it is not in his favor or her favor, he or she will not exercise their right. In the first case, it was beneficial, so he or she will exercise. In the second case, it's not beneficial, so they will not exercise. Any question? If it is the right to sell, let's suppose, then it will reverse. In the first case, for example, let me just, if it was the right to sell, it will be like this. I have the right to sell, let's suppose, at 125. Okay, and we keep all other information the same. So in the first case, what will happen? Situation number 1, situation number 2, and let's suppose this is T3, 3 months later. Okay, so the price is, let's suppose, ST is, let's suppose, 140 and 125. So my gain here would be, if I just go to PT, it will be maximum of X0 or X minus ST. So PT is maximum of 0. X is how much? 125. ST is how much? 140. So you see maximum of 0 or minus 15. So will I exercise my right? No. If I can sell something in the market for 140, why should I sell it for 125? So as a seller, because I have the right to sell, I will not exercise my right, because if I sell it 125, I will make a loss of 15, because in the market I can sell it for 140 and I'm selling it for 125. So not a good bargain. In the second case, if I look at the equation, I will have a situation where I have X greater than the ST, and that is why it will be beneficial. So I will be having maximum of 0 or 125 minus 120. So if I do this, it is maximum of 0 or 5, so it will be 5. Yes, it is beneficial. Why? I can sell it for 125, exercising my right. If I go to the market, I can sell it only for 120. So it is better to exercise my right and sell it for 125 than selling in the market for 120. So this is how you can calculate the payoff from the option if you have the right to sell. Any question on these two, please? So here is an example. At expiration, the underlying asset price ST is 28. If the strike price, exercise price is 25, what is the payoff of the put and call? So if it is a call option, you have the right to sell at 25 and you can buy it in the market for 28. So exercising the right to buy at 25 is beneficial. So your gain is 3. If you have the right to sell it for 25 and in the market it is selling for 28, then exercising the put option is not good, because if you exercise it, you will realize a loss of 3 minus 3. So therefore, not exercising it is favorable. The payoff will be 0. Now, whenever I'll just write this here like this: for call option and for put option, we know that whenever ST is equal to the exercise price, we call it, the option is at the money. Okay, at the money. Whenever ST is greater than X, the call option will be in the money. But for the same, I have to write it again, sorry. So this is call option and this is put option, and we just said that if ST is equal to X or NST is equal to X, so this will be, let me just write on this here. So for the call option, whenever ST is equal to X, it is at the money. And whenever ST is greater than X, it is in the money. And whenever ST is less than X, it is out of the money. For the put option, we will have the same. Whenever ST is equal to X, it will be at the money. And whenever ST is greater than X, it will be out of the money. Like in this case, you see ST is 28 and X is 25. And then ST being less than X, it is in the money. So these are important concepts for call: at the money, in the money, out of the money. And whenever the call is in the money, keeping other things constant, the put will be out of the money, and vice versa. It cannot be the case that with the same information, like in this case, you cannot have the call in the money and the put in the money. Okay, so with this information, either one of them will be in the money and the other will be out of the money. So the call is in the money here, ST being greater than X, and the put is out of the money, X being less than ST. Any question on this? And similarly, you can calculate the profit from the call and put. So the profit can be calculated, whatever your gain is from the, or the payoff is from the call or the put, minus the cost of the call option or minus the cost of the put option, because the right to buy or the right to sell, they will be purchased. Okay, in finance we say there are no free lunches. So if somebody is selling you the right to buy, that is, if somebody is selling you a call option, you will have to pay a price for buying that. Similarly, if somebody is selling you the right to sell, then you are buying a put option and you will have to pay the price of the put. So the profit from buying a call will be equal to the payoff from the call minus the cost of the call. Similarly, the profit from the buying of the put will be equal to the payoff from the put minus the cost of the put. Any question on this? Here we have an example for this. For the same, we have the exercise price equal to 30, and we have the call price initial at cost at $1 and the put cost at $2. Now the stock price at expiration is 27.5. So if we calculate this, the call is out of the money because the stock price is 27.5 and the exercise price is 30. So the payoff is 0. However, the price is 1 for the call. So the net profit from the call buyer for the call buyer is -1. The put buyer, on the other hand, has the put in the money. 30 is exercise price, stock price 27.5. So there is a $2.5 gain. However, the cost of the put is $2. So the net profit from buying the put is $0.5. Now, we discussed the two types of derivatives, the forward commitments and the contingent claim. And we said that the forward commitments have both the parties obligated. So the buyer has the obligation and the seller has the obligation. In the contingent claim, we said that the buyer has the right, whether call option or put option, and the seller has obligation, whether call option or put option. So that means that in the forward contract or in the future contract or in the swap, the payoff will be symmetrical. Okay, so both the gains and losses to the buyer and seller can be identical. Okay, they can be, I mean, like, if the buyer can make a 50% gain, the seller can also make a 50% gain in a different situation. However, in the option, the payoffs are asymmetrical. And what do we mean by that? The seller of a call option or a put option can only earn the call premium or the put premium. That is the price for the call option or the put option paid by the buyer. So the gains of the seller are limited. However, the losses of the sellers are or maybe unlimited. We will see that later. So the seller will have limited gains and unlimited losses. However, the buyer will have limited losses because the only amount he can lose is the price of the call or the price of the put he or she has paid to the seller. However, their gains can be unlimited in call option. In put option, the gains can be limited, but they will still be quite higher than the price they have paid for the put option. Is it clear now? In forward commitments, the gains and losses of the buyer and seller can be identically distributed. However, in the contingent claim or options, the buyer and seller's payoffs are asymmetrical. The seller will have limited gains and unlimited losses possibility, particularly in the case of call options, while the buyer will have limited losses and unlimited gains in the case of call option, as well as in the case of put options, but the gains are limited. Any question on this? So what are the purposes of derivatives, the gains from derivatives? So of course, you have used and you will be using derivatives for risk allocation, risk transfer, and risk management. This is one very important function. We will be doing particularly this and this one as well as this one at times. Derivatives are quite useful for price discovery. If you want to know what will be the spot price of oil 6 months from now, you can look at the oil futures contract, oil forward contracts, or if there are swap contracts on certain commodities or certain financial securities, you can use these to estimate the spot price in future for the underlying. The underlying can be commodities, can be financial securities. So price discovery, use of derivatives does help in price discovery. Implied volatility is a very important concept. You can use the option prices to calculate the implied volatility. Let me give you an example of this. When you were doing portfolio management course with Mingru, you calculated the standard deviation, isn't it? as a measure of risk for your portfolio or your stock when you were doing her coursework? Didn't you use standard deviation? You used it. Okay. Now, if I tell you that the standard deviation you calculated may be different. For example, you calculated the daily standard deviation of your stock and portfolio to be 10%. However, if you use weekly data, the same comes to be, let's suppose, 8%. Let's suppose, I'm just saying. And if you use monthly data, the standard deviation becomes, let's suppose, 12%. I'm just saying, I mean, like, I'm not saying that these are right. And if let's suppose, even if you use daily data, but if you use 1 year daily data, the standard deviation based on 1 year data is 10%. But if you use 2 years data, the standard deviation is 15%. If you use 3 years data, standard deviation, the same daily, it's daily, but you are increasing your sample size. So it is, let's suppose, 13%. Now tell me which one of these or these is the correct standard deviation. Can you tell me? Anyone? Which one is the correct definition or correct measure of risk? This, or any of these?
Is it the daily one?
None of these. None of these is correct. Why? If you are using 10%, this one, another person is using the 2 years one. Another person is using the weekly data. So if I tell you to give me one very close estimate, which is not affected by the type of data you use, daily, weekly, monthly, or the sample time you use, 1 year, 2 year, 3 year, you will have to come to the Black-Scholes option pricing model. And if you use the Black-Scholes option pricing model, there is a way of calculating what is the market consensus standard deviation. Do you get my point? What all of us collectively are considering to be the risk of the stock, which is not affected by either you using daily data, weekly data, monthly, or 5 years, 3 years, 2 years, 1 year's data. Is it clear? So this is one big advantage with the derivatives, particularly the Black-Scholes option pricing model for options, that you can get a very, important estimate of risk measure using this model. Then there are operational advantages also. It's relatively cheaper to trade in derivative market. The transaction costs are low. Liquidity is higher in derivative market than the spot markets, and short selling is much easier in derivative market than the spot markets. And derivatives market are more efficient than the spot markets. If somebody asks you which market is more efficient, futures market or spot market, the answer will always be futures market. Why? Because it's very easy to trade. There are less transactions, there is more liquidity, and these operational advantages leads to better exploitations of mispricing in derivatives market, and that keeps the market more efficient than the spot markets. I'll just take 5 minutes more so we can finish this, and tomorrow then we can actually revisit this. So one of the criticism on derivatives is that derivatives are very used for speculation, and they are basically gambling. That's not correct, because derivatives are also used for risk management function. And if there were no derivatives, a lot of the financial development and financial innovation that we see nowadays would have not happened. So there are people, there are institutions that misuse derivatives. They use it for gambling and speculation purposes, not gambling, but speculation purposes, and hence being equated with gambling. But that doesn't mean that derivatives by themselves are bad. Okay, you have to use them carefully and for economic purposes. They are considered to be destabilizing the financial markets and adding systematic risk to the financial systems. Yes, of course, that was one of the reasons, and I would recommend you to read about credit default swaps and their role in the 2007 to 2009 financial crisis. Tomorrow, when we have the drop-in session, we are going to cover all these aspects. So please read about this. But again, this has to do with how you use derivatives. It has been used in the past for speculative purposes, and at times have been used to destabilize, leading to destabilize, I would say, the financial system. But that again is quite subjective, and they are considered to be quite complex. As we move forward, we will see that their complexity is not their own creation. It is because the way risk originates in the financial system or in the economy, and the way they actually eliminate that risk or reduce that risk. We will see later on how we do that.